Welcome to the Opening Bell Report.
$18 billion. That's the number I just cannot get out of my head this morning.
It's a staggering amount of wealth. I mean, to just evaporate in a single day of trading.
And it's not just the money, is it? It's who we're talking about. If this was some, speculative crypto coin or a penny stock that crashed, fine.
Sure. Easy come, easy go.
That's the game.
Yeah.
But this is PayPal, the company that basically taught the internet how to pay for things. I mean, the blue P is on everyone's phone.
It is.
But looking at this analysis report we have here, dated February 4, 2026, it seems like the market didn't just sell PayPal yesterday.
Mm-hmm.
It tried to erase it.
That's a good way to put it. We see market corrections all the time. A stock drops 5, maybe 10% on bad earnings. It stings, but you move on.
Right.
But what happened to PayPal, dropping over 20% in one day, hitting lows we haven't seen since the post-eBay spinoff, that's totally different.
That's not a correction.
That is not a correction. The report calls it capitulation.
Wow, capitulation.
Yeah.
I mean, that's a heavy word.
It carries a lot of weight.
It means giving up, right? Like surrendering.
Exactly. It's the moment when the last bit of hope just, leaves the room. And that's really our mission for this deep dive. We're not just looking at a stock chart. We're performing an autopsy.
Okay.
We need to figure out why Wall Street completely turned its back on a household name. And I think more importantly, whether this is just a temporary freakout or the actual end of an era.
Well, let's start with the crime scene itself, the sheer violence of this move. The report states the stock is sitting at $41.70.
Which, for context, is just devastating. That wipes out pretty much all the gains of the last several years.
So if you bought PayPal 5 years ago thinking it was a safe, blue-chip tech stock,
you're underwater. You've lost money in a market that has mostly been going straight up.
And the report highlights something that, it just jumped right off the page at me. The volume.
Volume, yeah.
It says institutional selling was rampant, hitting 8 times the daily average. 8 times. Let's dig into that.
Okay, so that number 8x volume, that's the smoking gun.
Because that's not retail investors like you and me, right? Trading on our phones. We don't cause an 8x spike.
Not even close. When you see volume spike to 800% of the norm on a down day, that is the sound of whales exiting the pool.
Whales.
We're talking pension funds, mutual funds, those massive sovereign wealth funds. These guys have strict risk models. When a stock does what PayPal did, they don't ask questions. They don't wait for a bounce. They liquidate.
They're not trying to, time the bottom or get a slightly better price?
No, they're what we call price agnostic sellers. They just hit the sell button. Their mandate is to get that risk off their books immediately. And when you have that much supply hitting the market with no buyers,
the floor just falls out.
The floor falls out. It's a liquidity event.
The report uses a phrase for the chart pattern that I'd never heard before, but it sounds, unpleasant.
Gap and crap.
It is a bit crude, I'll give you that. But it's a classic trader term.
So what does it mean? Walk me through it. Okay, the gap is the opening price. The bad news came out overnight, so the stock opened way lower than it closed the day before. It gapped down.
Right. And usually when that happens to a big name, you see the dip buyers rush in.
Immediately. They think, oh, PayPal's on sale. It's 15% off. And they start driving the price back up.
Buy the dip reflex.
Exactly. But the crap part is what happened next. There were no buyers. It opened low and then just kept sliding lower all day. It closed at the absolute bottom.
That pattern tells you that even at these smash prices, the smart money didn't see value.
They saw a falling knife. They stayed away.
So if the what is this historic washout, you have to get to the what triggered it. Because companies don't lose almost $20 billion in value without a huge catalyst.
And the report calls this the triple threat.
The triple threat.
Yeah. Wall Street can handle bad news. It can handle one problem at a time. A revenue miss, a CEO change. Okay. But it cannot handle all three at the exact same moment.
And that's what PayPal delivered.
That's what they delivered. They threw the kitchen sink at investors, and it broke the floor.
Okay, let's break these down. Yeah. Shock number 1, the guidance cliff.
This is the one that really killed the narrative. You have to remember, for the last, 18 months, the story around PayPal has been a turnaround.
The comeback kid story. Stick with us, we're fixing it.
Exactly. They were selling hope. We'll get back to double-digit growth. And then they released guidance for 2026. And instead of growth, they guided for flat to negative earnings per share.
Flat to negative. So we aren't growing. We might actually be shrinking.
Yes. And you have to understand how investment models work. If I'm an analyst and I have to change my growth input from, say, plus 10% to minus 2%,
the whole model just collapses.
Mathematically, the valuation of the company collapses. They invalidated the entire thesis in one sentence.
Okay, that brings us to shock number 2, which feels more like corporate drama. The CEO, Alex Chris, is out. abruptly.
A massive curveball. He was supposed to be the savior. He hasn't even been there that long.
And for him to leave right when the numbers turn bad, it looks like fleeing the scene of an accident.
Or being pushed out because the board panicked.
Yeah.
Either way, it just screams instability. But it's the replacement that really has people scratching their heads. They're bringing in Enrico Lores.
From HP.
Formerly of HP.
HP as in Hewlett-Packard, the printer company.
The printer company. Now, look, Lores is a competent executive, but think about the optics here. PayPal is supposed to be fintech, cutting edge.
Right. Digital frictionless money.
And you bring in a CEO from a legacy hardware company, it sends a weird signal.
It signals that maybe they don't see themselves as a tech innovator anymore.
It signals they might be looking for a cost cutter. HP is known for managing declining businesses, not for hypergrowth. For a stock that trades on future potential, that is a deadly signal.
And then the final blow, shock number 3, the actual numbers, the revenue miss. They brought in $8.68 billion.
It's the growth rate that matters here. The report says they grew revenue at 3.7%.
3.7%. I mean, that's barely above inflation. That's standing still.
In the tech world, if you aren't growing at 15 or 20%, you're dying. But the report draws this really painful comparison. They put PayPal's 3.7% next to Adyen.
Adyen, the big competitor in back-end processing.
The European giant, yeah. And Adyen is growing at over 22%.
Ouch. So it's not that the sector is slow.
No.
People are still spending money online. They're just not spending it through PayPal.
And that's the terrifying part for investors. This proves the problem is idiosyncratic. It's a PayPal problem, not a market problem.
The triple threat. Bad numbers, worse future, Captain just jumped ship. That explains the sell-off. But I want to pivot to the deeper analysis in this report. The section titled, The Broken Thesis.
This is the most important part. This is why the stock didn't bounce.
Right, because I look at the valuation, and I have to play devil's advocate here. The report says PayPal is trading at a PE ratio of 8.4x.
Which is incredibly low.
It's bargain bin low.
Yeah.
The S&P is what, 20, 25? Tech stocks are often way higher. My gut instinct is buy. It looks cheap. Why is that wrong?
This is the classic value trap. It looks cheap, but it's cheap for a very deep structural reason. The report says Wall Street is reclassifying PayPal.
Reclassifying it as what?
As a utility.
A utility, like my electric company.
Exactly. Or the waterworks. Think about it. A water utility is essential. It generates cash. It pays a dividend. But it doesn't grow.
You don't expect your water company to invent a new kind of water.
You don't. It just exists. And because there's no growth, the market gives it a low multiple. You pay 8x or 10x earnings for a utility.
So the market is saying PayPal is no longer a growth stock. It's just internet plumbing.
And this creates a violent transition in who owns the stock. The growth investors, the funds that need expansion. They literally cannot own it anymore by their own rules. They have to sell.
Ah, so even if they like it, their charter says sell.
They have to. And the value investors, the ones who like cheap utilities, they might buy it. But they're slow. They are cautious. So you have a mass exodus of sellers and no one there to catch the falling knife.
That's the repricing event.
That's the repricing. And it all comes down to this idea of market share donation.
Donation is such a brutal way to put it.
Isn't it? You're supposed to fight for market share. They're just handing it away.
The math here is pretty stark. The report says the e-commerce market is growing at 8 to 10% a year. But PayPal's branded checkout, the button we all know, is growing at 1%.
That gap between 1% and 10%, that's the death zone. It means every single day, PayPal becomes a smaller part of the internet economy.
And the report names the beneficiaries, Apple Pay and Stripe.
It's the friction problem. Think about your own behavior. You're on your phone, you're buying something, and you see the Apple Pay prompt pop up. What do?
I just double-click the side button, Face ID scans, and I'm done. I don't even think about it.
Right. It's instant. No login, no password, no security questions.
I honestly can't remember the last time I actively logged into my PayPal account to buy something.
And that is exactly what institutional investors are terrified of. Apple owns the hardware, they own the operating system, they've put themselves between the user and PayPal. That friction is killing them.
Okay, so the high visibility part of the business, the button is stalling because of Apple. But wait, PayPal is still growing a little. Where is that 3.7% coming from?
That brings us to the third nail in the coffin. Margin compression. The growth is from their unbranded side, specifically a service called Braintree.
Which is their back-end processing, like what Stripe does.
Exactly. It's the invisible plumbing. And it's a good product, but here's the catch. It is low margin.
Why? Why is it lower margin than the button?
Because it's a commodity. In the background, you're competing on price with Stripe, Adyen, huge global banks. You have to cut your fees. But when someone clicks the blue PayPal button, PayPal owns that customer transaction. They can charge a premium.
I see. So the high-profit business is shrinking.
And the low-profit business is growing. That's called a mix shift. As the mix of revenue shifts toward the low-quality stuff, the company's overall profitability permanently goes down.
So they're having to run faster just to stay in the same place, profit-wise?
Exactly. An 8x PE isn't a bargain, it's a reflection of lower quality earnings. The market is pricing harder business model correctly.
This is, well, it's bleak. A broken thesis, a confused management team, a competitor that owns the playing field. Does the report offer any hope at all?
In the short term, no. The technical outlook section is ugly.
We broke $50, which I assume was important.
50 was a huge psychological floor, a round number, a historical level. Now that it's gone, the report says the next real support isn't until $40.
And we're at 41.70, so we are dangling right above the abyss.
And sentiment-wise, we are entering what the report calls the penalty box.
I've heard that term. What does it actually mean for a stock?
It means the stock is uninvestable for a period of time. The report estimates 12 to 18 months.
18 months. That's a lifetime in tech.
It is. But think about it from the institution's view. You have a new CEO. He has to come in, learn the business, create a new strategy, maybe hire his own team, and then execute for a few quarters to prove it's working.
Wall Street isn't going to take his word for it anymore.
Not a chance. They've been burned. They are in show-me mode. So until the numbers actually turn around, no analyst is going to risk their career recommending the stock. They'll all downgrade it to hold.
So it's dead money for a year and a half, best case.
Best case. Worst case, it just keeps drifting lower. A value trap.
It's a harsh lesson. You assume that just because a company is famous, it has to recover.
That's the danger of familiarity bias. Kodak was famous. Blockbuster was famous. Yahoo was famous. In tech, if you stop innovating, you don't stay the same. You die. And this report is basically PayPal's obituary as a tech giant.
It's now just a utility.
A utility.
That's the thought I want to leave our listeners with. If PayPal is indeed becoming the water company of the internet, does it even matter who the CEO is? Or is it just destined to fade into the background code of the web, making pennies on the transaction while Apple and others own the customer?
That is the multi-billion-dollar question. Can a utility ever get its innovation back? History says it's very, very hard. But for now, the verdict is in. The growth story is over.
A tough reality check. Thanks for guiding us through the wreckage.
Anytime.
Don't forget to like, share, and subscribe for more.